Hello everybody and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Carlos Sanchez, Director of Asset Management at CPM Group here in New York. Carlos, thanks very much for coming on the show.
Mike, thanks for having me again.
Now, as usual, I want to discuss with you metals. I know that's an area you focus on, and I seem to be having this conversation frequently nowadays because if we start off with gold, if we talk about the market, the features of the market, really sort of in a tight range these days. I think you would say 1250 on the downside, maybe to mid to high 1300s.
Yep. Yeah. I think what you've had, I guess, really since late February, early March, is gold prices have come off from testing 1375, 1380 or so, and moving between, basically, I would say it's even tighter. I'd say 1280 to 1320, 1330. I think part of that is the fact that equities have been taking all of the limelight, all of the attention from gold. A lot of investors have perhaps reduced some of their gold purchases, safety purchases, and gone into equities.
Well, that's a good point, and actually it's a point that I've been making, from the standpoint of competitive assets, other assets that might compete with gold. We have been seeing record highs, at least in the S&P and the Dow Jones. The stock market has been doing well. But on the flip side of that, and a lot of people are getting very cautious about stocks. We're seeing, I think, more forecasts of some sort of a correction.
Right.
If we have a correction, would that trigger a move back into gold? Because normally when you see stocks sell off, you see pressure on gold as well.
Yeah. I think that's what's happening to an extent. Yeah, you've seen stocks continue to rise over the past several quarters. But more recently, I think what you're seeing is investors are reducing some of their stock purchases, some of their equity purchases, and moving back into perhaps some safety assets. What you've seen more recently is bonds have appreciated somewhat. The interest rate in the 10-year was about close to around 3% a couple months ago. Now it's closer to 2.6%. Gold has come off, but every time it dips, again, as we mentioned, that 1280 mark, it keeps on moving back up fairly quickly on short covering or sparking buying interest because we're still not out of the woods yet. GDP across the world in the U.S. was 0.1%, which was a bad figure, 0.1%.
Right, very weak.
Yep. European GDP is still tepid, and China is not growing at that double-digit pace that we saw in previous years.
What about the dollar? In the past, gold has been very much a dollar story. We see recently, since the beginning of this year, the dollar has been weakening. We've seen it multi-year lows against the British pound. It's up near multi-year highs against the euro, close to 140 recently. Yet we don't see that typical reaction in gold that we usually do.
Yeah, I think a lot of folks, investors, have been thinking that some weakness in the dollar would have pushed gold prices higher, but I don't think that hasn't been the case, and I'd relate that more to we're in this non-inflationary environment. The massive push of the Fed pumping money into the market,
which has not resulted in any inflation.
Right, hasn't resulted in any inflation.
That surprised a lot of people.
Yeah, no, definitely. It's it surprised many folks, but I think it has pushed up inflation to some extent, but more so in the foods area, the agricultural area, not so much in housing, in the perhaps the other sectors like manufacturing, etc. So.
Now, let's talk a little bit about foreign demand, because China was a big factor for a long time, as was India. And I know you guys recently released your annual yearbook. You talk a lot about these trends. What are you seeing right now in terms of Chinese demand, in terms of Indian demand?
Indian demand, as you know, has been sort of put on hold somewhat because of the import restrictions on gold. So there is buying there, but not at the pace we saw as previous years because of those import restrictions with the deficit, import-export deficit that India is facing. As far as China, China is seeing a pickup in demand at times when prices do fall below that 1,300 mark, but we're past the seasonally strong period for demand. The new year is past, and given that prices are lackluster, I wouldn't be surprised to see Chinese investors wait for prices to move below 1280 to increase their purchases. And we may see that that lower level over the next couple months.
So would you say that the 1250 area is basically now the new floor?
I think that's going to be the new floor. I think 1280 right now is the floor that we're seeing. It's being tested, I think, today. The new floor, I think, going into June, July, August is going to be 1250 and probably 1200.
Now, I've not spoken to anybody, even bears, who think that gold prices could get back down below $1,000. Do you think that's like completely off the table? Like if you recall, in the last peak in 1980, that was $850 an ounce, okay? And then it backed off of there, and it took like 20 years for that level to get hit again. And then we know the story, it ran all the way up to 1900, and then, you know, it usually comes back down to that old high. You don't see it potentially going back down to that 850 again?
No, I don't see it. I think for a couple of reasons. You know, first of all, economically, financially, we're not out of the woods yet. There are many things politically that could go wrong. You have Russia,
right?
You have Syria. You still have the situation with Iran. You've got the U.S. On this unprecedented program of asset purchases, stimulus.
Well, they're backing off on that. There's the taper. They're down. They went from 85 billion a month down to 20 billion a month. So that, you know, some people say that's a removal of stimulus.
Some people would say that, but when you're still putting money into the economy,
I actually think I actually think that's more of a stimulus than the asset purchases, and I'll tell you why. Because the asset purchases removed that interest income. When the Fed was buying those securities, it removed that interest income from the economy. Now it's leaving them in there, and you know the economy is earning that interest. It's actually like a sort of a mini fiscal stimulus. I think it's actually bullish for gold. I know a lot of people don't look at it that way, but I'm contrarian. What can I tell you?
Yeah, no, I can see your point. I mean, it was bullish for gold, but since 2013, I don't think it has been as many people would have thought it would be, as given that prices haven't really risen the way they did when they reached 1920 and the way they did when the Fed began these stimulus programs. So this last stimulus program, the asset purchases program, which began in 2013 and is now being backed off, hasn't really pushed the prices higher.
Yeah.
I think another factor why gold prices are going to hold up is you have the cash cost of production, the all-in cash cost of production.
Right.
For many companies, that's now close to
1,200.
Yeah. 1,000, 1,200.
Yeah. No, that's a very at least longer term supporting factor. So what are we looking at now? It sounds like what you're saying is that if you're a long-term investor, you know, you accumulate down here, and yeah, maybe prices will dip a little bit further, low 1200s, who knows, maybe even slightly below for a short period of time, but longer term, you're going to be looking at this, and it was a great opportunity. Is that basically it?
Yeah, I think on a shorter term basis, perhaps you want to follow the trend, which is lower right now, into the summer, into June, July, August. I think you're going to hit those cyclical lows for the year and probably for the next several years. And I think that's the opportune time to stock up on gold.
All right, Carlos Sanchez, always a pleasure. Thank you very much.
Thank you, Mike.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.